There's a pattern running quietly beneath every empire that ever tried to shape the world. It doesn't begin with armies or leaders. It begins with control over movement. Who can move, who cannot, and who must pay the price to cross from one world to another. In 1914, when the Panama Canal opened and cut nearly 8,000 miles off the journey between New York and San Francisco, a new age of power began. And here's what nobody tells you. Whenever a single choke point carries even a fraction of global trade, it becomes more than an engineering project. It becomes leverage. It becomes a currency in its own right. And this is where the pattern begins. A corridor only 50 miles long suddenly held the potential to determine the rise or decline of entire economies. That pattern didn't start in the 20th century. In 1869, when the Suez Canal opened, Britain used it to tighten its grip on Asia and Africa. In 1588, when Spain failed to control the English Channel, its empire began to fracture. In 480 BC, when the Persians failed to secure the narrow straits at Salamis, their campaign ended in catastrophe. Over and over, the same story repeats. Waterways decide destinies. And here's why this matters today. Because analysts suggest this same ancient pattern may quietly shape the dynamics surrounding the Panama Canal once again. Only now the players are different, the stakes are higher, and the competition is embedded inside contracts, investments, and port operations rather than cannon fire. To understand why, let me show you exactly how a small strip of land became the spine of global shipping. The Panama Canal carries about 6% of all international trade. But the impact goes far beyond that number. It links the world's two largest oceans at the narrowest possible point, saving carriers weeks of time and millions in fuel. It connects American agricultural exports to Asia, Asian manufactured goods to the east coast of the United States, and energy shipments in both directions. The canal is not a route. It's a compression point. And compression points produce power, because anyone who influences what flows through them holds something every nation needs: time. Here's the mechanism. In maritime trade, time is money, and delays multiply like compound interest in reverse. A single-day delay at a canal entrance doesn't cost one company a little extra. It ripples through hundreds of supply chains, tightening inventories, raising freight prices, and shifting profit margins across continents. That's why, from the day it opened, the Panama Canal became a geopolitical prize. Not because of the land itself, but because whoever shaped its operation could shape global trade priorities. For most of the 20th century, the United States controlled the Canal Zone, and during World War II and the Cold War, it became a military artery as well as a commercial one. The corridors surrounding the canal were fortified, monitored, and treated as extensions of U.S. strategic doctrine. But when the canal transferred fully to Panamanian control in 1999, a new era began, one where the competition for influence shifted from gunboats to contracts, from territorial claims to long-term concessions, and from overt dominance to economic gravity. Here's what nobody tells you. Global power rarely moves through dramatic announcements. It shifts through infrastructure, roads, pipelines, fiber cables, and ports. Ports are not just docking sites, they are the on-off switches of global trade. That's why when analysts observed that a China-linked company won long-term concessions to operate the ports at both ends of the Panama Canal, Balboa on the Pacific side and Colon on the Atlantic, eyebrows were raised around the world. Not because anyone claimed the canal itself had been taken over. Not because Panama lost sovereignty, but because influence in logistics works like leverage. Small changes at the right point can move everything else. Here's why this matters. Modern supply chains operate on margins so thin they can be disrupted by subtle shifts in priority, pricing, or access. And in a world where major powers compete for trade influence rather than direct confrontation, ports become the new battlegrounds. Not war, flow, not invasions, access, not territory, logistics. This is the contrast the pattern keeps revealing, not guns, but gateways. The story becomes even more interesting when you follow the deeper historical echoes. The great European empires didn't just build colonies. They built coaling stations, refueling hubs, and supply depots. The British Empire at its height was a necklace of strategic ports: Gibraltar, Singapore, Aden, Malta, each acting as a choke point. The United States inherited a similar strategy through its bases in the Pacific, the Caribbean, and the Middle East. But in the 21st century, analysts note that China's global infrastructure investments, from East Africa to Southeast Asia to Latin America, resemble an updated version of that same pattern, only executed through commercial agreements and boardrooms instead of naval escorts. And here's the trap. Nations often focus on visible threats, military buildups, alliances, missile ranges, and ignore the silent architecture beneath their economies. The architecture that decides who pays, who waits, and who must reroute. When a foreign company gains a role in operating a crucial port, it doesn't need to declare control. Influence grows through priority lanes, pricing strategies, and the ability to shape supply chain expectations over decades. Let me show you exactly how the pattern deepens. Consider the way the canal functions when global demand spikes. Container ships line up on both ends, waiting days or weeks to pass. The difference between a 3-day backlog and a 9-day backlog can shift billions in global shipping costs. If one company has influence over port operations at both entrances, it doesn't automatically control canal policy, but it does sit at the choke points where ships queue, where schedules are set, and where commercial decisions can create ripple effects across the Pacific and Atlantic. And here's what nobody tells you. Control of a choke point is rarely about domination. It's about shaping the flow in ways that compound over time. A slight priority shift in one direction or another. A subtle advantage for certain routes. A pattern of timing that, over years, becomes normal. Influence grows not through bold moves, but through small, consistent ones. By the mid-2000s, analysts were already discussing how global trade routes were becoming leverage instruments. By the 2010s, the conversation expanded to include China's Belt and Road Initiative, which emphasized ports, logistics hubs, and maritime corridors. And by the 2020s, when droughts temporarily reduced Panama Canal capacity and forced ships to take longer routes around South America, the world saw exactly how vulnerable its supply chains had become. Not because of war, because of water. Not armies. Access. Not conflict. Dependence. Here's the mechanism that ties it all together. Choke points magnify whoever stands closest to them. And when a major power positions itself at both ends of a crucial waterway, even through commercial operations, analysts pay attention because it mirrors the deepest patterns of empire strategy. But here's why this matters even more. The Panama Canal is not just a lane of traffic. It is a pressure valve for the global economy. And pressure valves determine who feels strain first. For over a century, the canal has appeared stable, inevitable, permanent. But stability is an illusion built on water levels, investment cycles, and the quiet agreements that govern port operations. The real danger wasn't what governments announced. It was what supply chains quietly depended on. And when dependency meets competition, the smallest shift can produce the largest shock. So, the question you're left with, the question no one answers directly, is this. What does it mean when a single nation holds commercial influence on both sides of one of the world's most important arteries? Analysts debate this constantly, offering scenarios rather than certainties, but they all point back to the same truth. Control of flow is control of power. And yet, the most dangerous part of this story hadn't even started yet. Because to understand what this choke point means for the modern world, you have to look at the long arc of waterway power, a history that shows how nations rise not by conquering land, but by shaping routes. From the moment the first shovels broke the earth in Panama in 1904, the world understood that this wasn't just an engineering project. It was an attempt to alter geography itself. But here's what nobody tells you. Whenever humans try to rewrite nature, they also rewrite power. And the struggle for control over passageways, rivers, canals, straits has shaped every empire from the Persians to the British. The Panama Canal is simply the most modern expression of that ancient contest. To see why today's tensions feel familiar, you have to go back to the early 20th century, when the United States stepped onto the global stage and treated the Caribbean not as a region, but as a defensive perimeter. In 1914, when the canal opened, Washington gained something no other nation possessed: the ability to move fleets between oceans with unprecedented speed. That mattered more than trade. It meant that, unlike European empires stretched across two hemispheres, the United States could reinforce either coast in days instead of weeks. Here's the mechanism. Mobility multiplies power. The faster a military or commercial system can shift its assets, the harder it is to threaten. And because the Panama Canal accelerated mobility, it rewrote the strategic calculus of the entire Western Hemisphere. This is where the pattern begins. But the idea of a nation rising through control of a waterway is centuries older. Consider the Ottoman Empire in the 16th century. It leveraged the Dardanelles and Bosporus, narrow, treacherous straits barely a mile wide in places, to control access to the Black Sea. Whoever wanted to trade grain out of Ukraine or timber from the Caucasus paid the empire with goods, coin, or obedience. Not empire through conquest. Empire through access. Or look at Britain in the 19th century, which understood that whoever controlled the Suez Canal held the shortest route from Europe to India. That canal didn't just shorten trips, it shortened the distance between imperial orders and enforcement. And when Britain bought a controlling stake in the canal in 1875, it signaled something deeper. Power flows through bottlenecks. Let me show you exactly how these patterns converged in Panama. When the U.S. took over the stalled French Canal project in 1904, the French failure wasn't the only thing America inherited. It also inherited the geopolitical blueprint that had shaped European maritime empires for centuries. The idea was simple. If you can control the narrowest point between oceans, you can shape global trade. If you can shape global trade, you can shape global dependence. And if you can shape dependence, you can shape outcomes. This wasn't theoretical. During World War II, the Panama Canal became the hinge that allowed the United States to rapidly redeploy warships between the Pacific and Atlantic. Without that hinge, naval planning would have resembled the fragmented strategies of older empires. With it, the U.S. Navy could act as a single, unified force. Here's why this matters. Mobility is not just a military asset. It is an economic one. Every tanker, freighter, and supply ship passing through the canal carried with it the leverage of speed. The same leverage nations have fought over since the first merchant ships crossed the Mediterranean. But nothing stays static. The same pressures that elevated the canal also exposed its vulnerabilities. In the mid-20th century, nationalist movements rose across Latin America, and for many, the U.S.-controlled canal zone symbolized an era of foreign dominance. By the 1970s, a shift was inevitable. In 1977, the Torrijos-Carter treaties mapped out the canal's eventual transfer to Panama, a process completed in 1999. Many outside observers viewed this as a symbolic end to America's Big Stick era in the hemisphere. But others saw something different. A vacuum forming around one of the world's most precious choke points. A vacuum that global powers would eventually try to fill. Here's what nobody tells you. Whenever a choke point loses a single dominant guardian, it rarely becomes neutral ground. Instead, it becomes a stage. Multiple nations begin watching, investing, negotiating, or positioning for influence. That's what happened with the Suez Canal after Egypt nationalized it in 1956. It's what happens periodically in the Strait of Hormuz, where 20% of the world's oil exports sail past the Iranian coastline. And it's what analysts argue may have begun happening in Panama when global interest surged around port concessions near the canal. After 1999, Panama inherited full responsibility for canal operations, but port operations, the infrastructure at the gateways, were a separate story. Global companies from multiple nations sought contracts, knowing that the ports were the throttle points where ships queued, loaded, unloaded, and coordinated passage. And this is where the modern twist enters. Analysts pointed out that by the early 2000s, a China-linked company secured long-term operation of the ports at both ends of the Panama Canal, Balboa on the Pacific, and Colon on the Atlantic. Not a military takeover, a commercial concession. Not control of the canal, control of the entrances. Here's the trap. People often imagine power as something loud: soldiers, ships, flags. But logistical influence is quiet. You don't need to own the canal to influence how trade flows through it. You just need to operate the places where the world waits. The canal is the artery. The ports are the valves. Historical patterns make this even clearer. In the 17th century, the Dutch Republic didn't try to dominate oceans through overwhelming military force. They built the world's most efficient ports and merchant fleets. In the 18th century, Britain didn't need to own every island. It needed control of the coaling stations where its steamships refueled. Whoever owned the infrastructure shaped the flow. Here's what nobody tells you. Global dominance often belongs not to the nation with the strongest army, but the one with the strongest logistics. And that brings us back to the quiet transformation around Panama. As analysts studied the rise of foreign-operated port terminals near the canal, they began drawing parallels to choke points throughout history. The Strait of Malacca, through which one-third of global trade passes. The Bab el-Mandeb near Yemen, where the Red Sea meets the Gulf of Aden. The Suez Canal, where even a single-wedged container ship in 2021 disrupted $9 billion of trade per day. Not accidents, vulnerabilities, and vulnerabilities attract competition. Let me show you exactly how the pattern of competition accelerates. Once a major power gains a foothold near a choke point, rival nations begin investing, negotiating, or reinforcing their presence through diplomatic or commercial means. Not because they expect conflict, but because they fear disadvantage. This creates a cycle. Presence begets presence, investment begets investment, and the choke point becomes a mirror of global rivalry. And here's why this matters. The Panama Canal is not just a Latin American asset. It is a global skeleton key. When droughts struck Panama in the early 2020s and reduced canal traffic, shipping carriers rerouted thousands of miles. Freight rates surged. Delivery timelines stretched. Supply chains trembled. And analysts pointed out that in a world where 6% of global trade depends on stable access through a narrow isthmus, even small disruptions can become global shocks within days. This is where the historical parallels deepen even further. Nations rarely fight over canals directly. They compete through influence. In the 19th century, France and Britain vied indirectly for dominance around the Suez through loans, concessions, and political pressure. In the 20th century, the U.S. treated the Panama Canal as a hemispheric safeguard. In the 21st century, analysts describe a new pattern. Global powers expanding influence not through flag-raising, but through the acquisition of commercial nodes in strategic supply chains. Not war. Logistics. Not ownership. Access. Not declarations. Concessions. Here's the mechanism tying all these eras together. Whoever shapes the flow of goods shapes the choices of nations. And when a single country, through companies linked to it, operates the ports at both ends of a canal that shortens global routes by thousands of miles, the world pays attention. Not because anyone believes it will shut the doors, but because influence at the entrances means influence over expectations. And expectations, when compounded over years, can drive global strategy. But the most revealing chapter of this story is still ahead. Because to understand what the Panama Canal represents today, and why analysts describe it as a pressure point in 21st century competition, you have to look at how these patterns play out in the present, where trade, investment, and geopolitical rivalry bleed into each other in ways that echo every era of global power before it. Because the decisions made around this narrow strip of water didn't freeze in the past. They're unfolding right now. Analysts examining the modern map of global power often begin with satellites, militaries, or GDP charts. But here's what nobody tells you. If you really want to understand how influence moves in the 21st century, you don't start with what nations say. You start with where their ships wait. And when you look at the Panama Canal today, the patterns of congestion, the investment footprint, the foreign-operated terminals at either entrance, you see a landscape shaped not by speeches, but by logistics. This is where the pattern begins. A small country with a narrow waterway suddenly positioned between two global economic giants, each interpreting the other's moves as signals, each reading the canal not as history, but as leverage. To understand the modern dynamic, let me show you exactly how the canal functions as a strategic mirror. Every day, massive container ships approach the Pacific entrance near Balboa, where operations are managed by companies linked to Chinese interests. On the Atlantic side, at Colón, another terminal operated by a similar network handles vessels preparing for or completing transit. These terminals are not Panama Canal Authority assets. They are commercial ports. But here's the mechanism. In global trade, commercial ports are the lungs that feed the arteries. They determine the rhythm, the tempo, the breath of the entire system. And because these ports sit at both ends of one of the world's most vital arteries, analysts pay close attention to their ownership, contracts, and long-term incentives. Now, here's why this matters. The United States historically saw the canal as central to its hemispheric influence. After 1999, Panama took full control of the waterway, rightly and sovereignly, but commercial concessions around the canal became open to global bidders. China's global companies, eager to expand their maritime footprint under initiatives that emphasized port acquisition, saw opportunity. American analysts called it strategic. Chinese commentators called it commercial, and Panamanian officials described it as business. Three interpretations of a single set of facts, and that contrast alone reveals the tension inside the modern map. At first, these developments looked like ordinary globalization. Foreign firms operate foreign ports all the time, but the canal's geography changes the math. Because whoever operates the ports at the entrances controls the queues, schedules, yard logistics, and container transfers that frame the canal's usage. Not the canal itself, but the experience of accessing the canal. And here's what nobody tells you. Influence often grows in the space between two systems. Between sovereignty and logistics. Between control and operation. Between the canal and the ports that feed it. But the modern story becomes even more layered the moment you introduce climate stress. In the early 2020s, Panama experienced one of the worst droughts in its recorded history. The canal depends on fresh water from Lake Gatun, and reduced rainfall forced authorities to slash the number of daily transits. Ships rerouted around South America or waited for slots in long queues. Freight prices surged. Retailers on the opposite side of the world paid the cost. And observers noticed something deeper. Global supply chains had become so tight, so optimized, so brittle, that a single bottleneck in Panama could ripple through factories, grocery stores, and fuel markets thousands of miles away. Here's the mechanism linking all this together. Choke points amplify stress. When the canal's capacity shrinks, every decision made at its entrances, which ships move first, which cargo gets priority, how vessels stack in line, becomes magnified. This is why analysts view commercial port operators as more than dock managers. They are gatekeepers in times of scarcity. Whoever manages the gates shapes the flow. Whoever shapes the flow shapes the consequences. But here's the trap. In the modern world, influence rarely announces itself. It hides inside spreadsheets and contracts, not gunboats. And many ordinary people don't see how global logistics connect directly to their wallets. A drought in Panama can raise shipping rates for electronics in Europe. A backlog in Balboa can delay agricultural shipments to Asia. A shift in port priorities can affect fuel prices on the U.S. East Coast. These aren't abstract problems. They are consequences that show up in grocery aisles, car dealerships, and shipping invoices. Let me show you exactly how the strategic tension grows. In Washington, analysts describe China's port operations near the canal as part of a broader pattern. Investments in dozens of ports worldwide, creating a maritime network that mirrors the coaling stations and supply hubs of earlier empires. In Beijing, commentators describe these same moves as normal commercial expansion, a way to connect global markets and secure stable trade routes. Meanwhile, Panama positions itself as a global crossroads, seeking investment from all sides to modernize and expand its role in international commerce. 3 perspectives. 1 canal. But here's what nobody tells you. Power often lies in the gaps between perspectives. When one nation sees strategic encirclement, another sees commercial opportunity. When one sees influence, another sees investment. The ambiguity itself becomes leverage. Because if no one can fully agree on the meaning of a port contract, its impact can stretch far beyond its legal terms. Let's zoom out. In the past 20 years, control, or even perceived influence, over maritime choke points has been at the center of global competition. The South China Sea disputes revolve around shipping lanes worth trillions. The Arctic is opening new routes that major powers want to shape. Russia monitors the Kerch Strait. Iran holds geographic leverage over the Strait of Hormuz. Egypt, through Suez, sits atop one of the world's most profitable canals. And now Panama, a nation of just a few million people, finds itself in a web of international attention because of who operates its ports, who transits its canal, and who depends on its water. Not armies. Water, not occupation. Logistics, not battles. Backlogs. Here's why this matters. The Panama Canal is one of the only places on Earth where global power is compressed into a single line of ships. When you study the images, vessels stacked at the Pacific entrance, waiting for clearance, you're seeing global trade literally paused, like a heartbeat slowed by stress. And analysts point out that in a world shaped by just-in-time shipping, even slight disruptions create immediate consequences. In 2023 and 2024, when historic droughts forced transits down to around 24 ships per day, some carriers paid millions in auction fees just to secure a passage. Others rerouted around Cape Horn, adding weeks to travel times. Insurance premiums shifted. Commodity markets adjusted. Economists argued over the ripple effects. And through it all, the operators at the entrances, though not responsible for water levels or canal policy, played a role in managing the overflow of demand. That's the landscape analysts examine, a landscape shaped by climate, contracts, competition, and geography. Now let me show you exactly how scenarios emerge from these signals. Some analysts argue that port operations near choke points could become a form of long-term influence, not through overt control, but through capacity to shape flow in moments of global stress. Others argue that Panama retains full sovereignty and operational oversight, meaning foreign-operated terminals are simply commercial assets with limited strategic implications. Still, others describe a gray zone, where influence is indirect, cumulative, and contextual, a matter of incentives rather than orders. Here's what nobody tells you. Modern power seldom moves in straight lines. It moves in incentives, and ports create incentives. The companies that operate them decide on investments, technologies, workforce training, and long-term development goals. Over decades, those choices shape how efficiently the canal's entrances operate, which in turn shapes the canal's overall experience for shippers, which in turn shapes global trade expectations. Influence built not through force, but through time. We also have to consider a growing fear among analysts. Climate unpredictability. If water levels continue fluctuating, the canal may require structural upgrades, new reservoirs, or technological adaptations that could cost billions. Who funds that future? Who partners with Panama for long-term modernization? Whoever steps into that role may gain influence not through existing concessions, but through future investment. And that is where the modern map becomes even more complicated, because global competition is shifting from control of land to control of nodes. Nodes like Balboa, nodes like Colon, nodes like the canal itself. Here's why this matters. If one nation becomes a dominant investor in the infrastructure surrounding the canal, the implications extend far beyond Panama. It could subtly shape supply chains across the Americas, Asia, and Europe. And because the canal moves 6% of global trade, even small shifts at its entrances can influence economic calculations worldwide. But the key question, the one that analysts debate but never fully answer, remains unresolved. What happens when control of flow becomes more valuable than control of territory? The modern world hasn't worked out the answer yet. But the way analysts frame the Panama Canal today, as both a commercial asset and a geopolitical pressure point, suggests that the stakes are rising. And if the patterns of history continue, the decisions made around this narrow strip of water may influence the shape of global competition for decades. Yet, the most revealing part of this story hasn't unfolded. Because to understand what the canal's future may hold, and how global powers might respond, you have to consider the scenarios analysts see on the horizon. And those scenarios are far more dramatic than anything in the past. There's a moment in every geopolitical contest where the past stops offering answers and starts offering warnings. The Panama Canal has reached that moment. For over a century, it has been a symbol of engineering triumph, global ambition, and economic interdependence. But here's what nobody tells you. Every choke point eventually becomes a prediction. Not of what will happen, but of what could happen if the wrong pressures collide. And in the 21st century, the canal sits at the crossroads of three forces moving simultaneously: global competition, climate volatility, and the fragility of hyper-optimized supply chains. This is where the pattern begins. Scenarios aren't guesses anymore. They are signals. Let me show you exactly how these scenarios unfold. The first begins with stability, the version of the future many hope for, one where Panama continues to play the role of neutral gatekeeper and global trade flows remain predictable. In this scenario, Panama maintains diversified investment partnerships, keeps foreign influence in balance, and modernizes the canal with new reservoirs or expanded infrastructure. Shipping companies adapt, governments cooperate, and the canal stays what it has been since 1914, a hinge between the world's two largest oceans. Here's why this matters. Stability scenarios rarely make headlines, but they are the backbone of global commerce. If Panama succeeds in sustaining autonomy while welcoming investment from multiple nations, the ports at Balboa and Colon remain commercial gateways rather than geopolitical flashpoints. In this future, drought mitigation becomes the central challenge instead of rivalry. Analysts describe this as the managed equilibrium model, a future where no single country dominates the canal's periphery, and global trade continues adjusting around it rather than trembling at every disruption. But here's what nobody tells you. Stability doesn't eliminate pressure. It delays it. It forces competition underground. Nations still compete for access, influence, and priority, but they compete through long-term contracts, technology partnerships, and deepening commercial ties rather than confrontation. The risk doesn't disappear. It becomes quiet. Now, consider a second scenario, one many analysts watch closely. Not war, not confrontation, competition. A slow tightening of strategic interest around the canal as global powers try to shape its future through economic gravity. In this scenario, China continues investing in infrastructure across Latin America, including ports, energy projects, telecommunications, and trade zones. Its linkages near the canal expand, not through declarations but through incremental deals. Washington, interpreting this as strategic encroachment, increases diplomatic and economic engagement with Panama and surrounding nations. A tug-of-war emerges, subtle, persistent, unspoken. Here's the mechanism driving this scenario. Influence grows through accumulation. A port concession here, a logistics corridor there, an infrastructure loan, a trade agreement, a training program. None of these shifts the balance alone. But together they form a lattice, a framework that shapes the incentives of the host nation. Not control, alignment. And alignment, particularly around a resource like global transit, is power in its softest, quietest form. In this scenario, foreign-operated ports at the canal's entrances become bargaining chips in a larger game. Not because they are weapons, but because they sit at the choke point where world trade slows to a crawl and waits for permission to enter a different ocean. This is what nobody tells you. The future of the Panama Canal may not be decided by the authority that runs it, but by the incentives of the companies that feed it. A nation may control the waterway, but companies influence the rhythm of access. And here's why this matters for the world. Competition-driven scenarios tend to reshape trade patterns. If global powers interpret each other's moves as strategic rather than commercial, even routine investments can trigger countermoves. Panama becomes a symbolic prize, not because anyone wants to dominate it, but because no one wants to surrender the possibility of influence. A choke point can become contested without a single soldier setting foot near it. But the third scenario is the one few discuss openly because it reframes everything. A world where the biggest threat to the canal isn't rivalry, it's water. In this scenario, climate volatility intensifies. Rainfall becomes unpredictable. Lake Gatun struggles to maintain the levels needed for daily transits. Even with new reservoirs or engineering breakthroughs, the canal faces recurring years of reduced capacity. The global economy, reliant on predictable routes, starts treating Panama not as a certainty, but as a variable. Here's the trap. A choke point that loses predictability loses leverage. If shippers begin planning routes that bypass Panama altogether, whether around Cape Horn, through expanded Arctic lanes, or via alternative logistics networks, the canal's centrality begins to erode. Not catastrophically, gradually, one shipment at a time. And here's what nobody tells you. When global trade shifts away from a choke point, geopolitical interest eventually shifts with it. Influence follows value. Value follows flow. Flow follows predictability. If drought conditions intensify unpredictably, foreign powers may invest less in Panama and more in alternative corridors, rail across Mexico, Arctic shipping routes, or new canal ambitions through Nicaragua, a project long theorized but never completed. Whether these alternatives ever fully materialize isn't the point. The point is the emergence of options. Options weaken choke points. Let me show you exactly how this scenario unfolds. Imagine a decade of intermittent drought. Each year, transits fluctuate. Shipping insurance rises. Retailers adjust inventory timelines. Carriers develop contingency routes. Investors begin shifting their attention to more stable corridors. The canal remains vital, but no longer automatic. And in this scenario, Foreign operators at its entrances benefit less from strategic rivalry and more from commercial opportunity. Their goal is no longer influence, it's adaptation. But there's a fourth scenario, the one no one wants to imagine yet everyone must consider: a hard break. A moment when competition, climate stress, investment pressure, or geopolitical tension aligns in a way that forces a major shift. Not a conflict, a rupture of assumptions. Analysts don't predict this, but they model it, because history has a habit of transforming choke points faster than anyone expects. Think of Suez in 1956. A nationalization triggered an international crisis. Think of Hormuz in 1979. A regional revolution turned a strait into a global pressure point. Think of the Ever Given in 2021. A single ship paralyzed $9 billion of trade every day it remained stuck. The pattern is clear. Choke points magnify weak points, and weak points don't announce themselves. They reveal themselves under stress. In a hard break scenario, a sudden shift, political, environmental, financial, forces Panama to make decisions under pressure. Nations watching from afar interpret those decisions through the lens of rivalry. Companies operating at the entrances find themselves handling surges or shortages beyond their capacity. And global markets respond instantly, not gradually. Here's why this matters. The world today moves at a speed older empires never imagined. A single misstep at a choke point can produce immediate global consequences. And the canal, operating with thin margins and heavy dependence on fresh water, is one of the most vulnerable. But none of these futures are guaranteed. They are scenarios, frameworks analysts use to understand the pressures shaping the canal. And the future Panama chooses, or adapts to, will depend on forces far bigger than contracts or concession agreements. Let me show you exactly what those forces are. Economic incentives: who invests, who withdraws, who builds resilience. Climate trajectories: drought cycles, rainfall patterns, reservoir capacity. Geopolitical strategies: how global powers interpret each other's moves. Logistics innovation: whether alternatives to the canal become viable. Panama's own decisions: its autonomy, partnerships, and long-term planning. What nobody tells you is that the canal's next chapter will not be about dominance. It will be about margin, the razor-thin space between efficiency and rupture. The world built a supply chain system that assumes Panama will always operate smoothly. But assumptions are the weakest foundation for global power. So the real question becomes this: which scenario will define the next decade of the canal? Analysts debate. Investors position. Governments calculate. But the answers remain open, because the most decisive choices have not yet been made. And the scenario with the greatest consequences, the one that blends all these pressures into a single outcome, is still waiting ahead. History has a way of whispering warnings before it ever raises its voice. And when you trace the long arc of choke points, from the straits that fed ancient empires to the canals that built modern ones, a single truth becomes impossible to ignore. Here's what nobody tells you: power doesn't just come from strength. It comes from vulnerability. Whoever understands the vulnerabilities woven into global trade can shape the future without ever firing a shot. And when you look at the Panama Canal through that lens, you begin to see not just a waterway, but a lesson. One carved through centuries of empires rising and falling around the narrowest points on Earth. The first lesson is older than the canal itself. Geography rewards those who respect its limits. In 480 BC, the Persians lost their fleet at Salamis because they misread the winds and currents inside a narrow strait. In 1571, the Ottomans lost control over key Mediterranean routes when they underestimated rival alliances built around maritime logistics. In 1869, the opening of the Suez Canal shifted global trade so quickly that older ports withered in a single generation. And in 1914, the Panama Canal became the hinge of hemispheric power, a shortcut so valuable that entire naval doctrines were rewritten around it. The pattern is unmistakable. Choke points don't just move ships, they move empires. Here's why this matters. Every time the world centralizes its trade through a single corridor, that corridor becomes a compass pointing toward the future. In the mid-20th century, the Panama Canal's reliability made it a symbol of American stability. In the late 20th century, its transfer to Panama symbolized a new era of shared global interdependence. And in the early 21st century, analysts argue that its vulnerabilities, water scarcity, port concessions, and geopolitical competition symbolize a world shifting from predictable order to economic fragility. But the second lesson is sharper. Let me show you exactly how it works. Power accumulates where assumptions gather. For decades, the world assumed the canal would always function. Always carry ships, always maintain water levels, always run smoothly. That assumption shaped supply chains, pricing models, and shipping timelines. It also created a hidden dependency. When droughts struck in the 2020s and transits dropped, the world didn't just experience delays. It experienced a revelation that one narrow strip of land still holds billions of dollars hostage whenever nature decides to tighten the flow. Here's the mechanism beneath that revelation. Efficiency becomes danger when it removes redundancy. The global economy built itself around Panama because Panama worked. But that dependence is a trap, not because the canal fails constantly, but because it doesn't fail often enough for the world to prepare alternatives. The greatest threats are the ones people forget to imagine. And here's what nobody tells you. The canal has always been more fragile than its reputation. Freshwater dependence, climate cycles, political expectations, commercial influence at its entrances. Every factor that made the canal powerful also made it delicate. Every year that passed without disruption strengthened a global illusion, the illusion that the canal's stability was guaranteed. The third lesson comes from understanding how empires disguise their strategies. Not every nation announces its ambitions. Some build them quietly, port by port, contract by contract. In the 19th century, Britain didn't dominate the world by conquering continents. It dominated by controlling coaling stations, the fuel points that every ship depended on. In the 20th century, the United States didn't reshape the world by owning every harbor. It did it by controlling the logistics architecture that fed post-war trade. And in the 21st century, analysts observe that China has pursued a similar strategy through commercial acquisitions, building a network of ports that form a modern chain of influence stretching across Asia, Africa, Europe, and the Americas. Not empire. Infrastructure, not domination. Dependence, not conquest. Connectivity. Here's why this matters. When China-linked firms operate the ports at both ends of the Panama Canal, analysts interpret it through the lens of that larger pattern. They don't see conquest, they see positioning, influence assembled not through force, but through access. Hints of future optionality, a logistical foothold at a global choke point that matters to every nation on Earth. And the reason this interpretation persists, even among those who disagree with it, is that history keeps reinforcing the same lesson. The nations that invest in choke points do so for reasons that echo through decades. But here's the trap at the heart of this lesson. People often misjudge power by looking at what is owned rather than what is influenced. A country doesn't need to control the canal to shape global perceptions of it. It only needs to sit close enough to steer the margins, the delays, the queues, the logistics that frame the user experience. Influence hides inside those margins. And when margins get tight, influence grows louder. The fourth lesson is uncomfortable but necessary. Future power doesn't belong to the nations with the largest armies. It belongs to those who control or shape the nodes that global trade refuses to live without. In the 16th century, Spain's wealth flowed through its treasure fleets, and when it lost control of its maritime lanes, Its empire cracked. In the 20th century, oil choke points determined wars and alliances, and in the 21st century the corridors carrying containers, data, fuel, and manufactured goods have become the new front lines. Here's what nobody tells you. The Panama Canal is one of the few places where these front lines converge. It is a physical choke point, a commercial artery, a climate-sensitive system, and a geopolitical mirror, all in one. And because the world depends on it, analysts study every signal around it: rainfall trends, port expansions, foreign investments, U.S. engagement, carrier routes, infrastructure proposals. Each signal hints at a future that is not yet solidified. Let me show you exactly how analysts frame that future. They don't ask who owns the canal, they ask who invests around it, who influences its access points, who depends on it most, who suffers if it slows, who benefits if it shifts, who is preparing alternatives, who is waiting for weakness. Those questions reveal something deeper. The canal's future isn't just a Panamanian issue, a Chinese issue, or a U.S. issue. It's a global issue hiding inside a narrow seam of geography. And the lessons from every previous choke point teach the same thing: that whoever prepares earliest for a shift in flow gains leverage in the new order that emerges afterward. But the final and most important lesson is this: history doesn't repeat in the same form. It repeats in the same structure. Rome built grain fleets. Venice built trade monopolies. Britain built coal networks. The United States built container corridors. China built port chains. Every era builds a system of flow. Every system of flow depends on choke points. And every choke point eventually asks the same question: who will shape the next chapter? Here's why this matters for every viewer. Because the canal is not just a story about ships and oceans. It's a story about money, prices, supply chains, inflation, energy, shipping rates, retail costs, manufacturing timelines, the quiet forces that shape the economy you live inside every day. If you've ever wondered why certain things cost more, why shortages hit harder, why global markets react instantly to disruptions thousands of miles away, the answer often begins at the choke points. Not in boardrooms, not in headlines. In the narrow places where the world squeezes itself into a single line. And as analysts often point out, the future of global stability may depend on how nations handle the pressures around these narrow places, including the one carved through Panama more than a century ago. So here's the final truth. The one the past keeps repeating but the world keeps forgetting. A choke point is not merely a route, it is a revelation. It shows you where power hides, where vulnerability lurks, and where the next shift might come from if history decides to turn sharply once again. If this framework is right, even partially, then the Panama Canal is not just a waterway. It is a warning wrapped in geography. A reminder that the forces shaping global trade today will determine the balance of global power tomorrow. And if this opened your eyes to how money, influence, and history intertwine across oceans, then the rest of the answers aren't hidden in the future. They're hidden in the past.